So let's talk about it with tonight's market panel. Chief Market Strategist for StoneX, Kathryn Rooney Vera. Also Veritas Financial Group founder and managing partner, Greg Branch. It's our bull-bear debate. Thank you for joining. Last call to both of you. So here's how things stand out. And Kathryn, we'll start with you first. If you take a look at the way that the markets have shaped up, it is one of those situations where it caught a lot of people off guard. This week, inflation data. Why is the market so bullish right now when it seems like so many Americans are still feeling some economic pain?
Well, it's the Goldilocks scenario, Dom. It's inflation coming down with near record low unemployment. So yes, people have some pain at the pump and with prices, but they have jobs. So the fact that the evidence is increasingly favorable for the soft landing viewpoint and immaculate disinflation is what has the market going crazy. So what I would say has the possibility of bringing sentiment lower is the fact that this is kind of the consensus trade now. This is the overcrowded trade, long risk assets. And the fact is that we can't really, at this point, declare mission accomplished with regard to inflation. Core PCE is still at 4.6%. The target is 2%. Yes, we're in a disinflationary trend, but I would argue that last leg, getting to the 2% target, is going to be the most difficult one, especially with the labor market as red hot as it is.
Now, okay, so Kathryn, I'm going to give the last word to you here. We know that you're pretty bullish on what's going on. You think that there might be some legs here for this market rally to continue. It's tough for a lot of traders and investors out there to buy a stock like, say, a Meta or an Nvidia that's already more than doubled over the course of this year-to-date period. What exactly then do you put new money into? Is it still big tech or is it something else?
I think you can rotate out of the growth stocks and into the value stocks. I think it's time to make that rotation if, in fact, the real economy does hold up from now through year end. And I think that's the case. I don't disagree with Greg that things can look dicey going into the following year. But with the labor market where it's at right now, I do not see recession as an imminent threat. In fact, if the July CPI data comes out strong and we end this year around 3%, that, in my view, increases dramatically the chances of no recession in 2024. Why? Because real wages are positive and sustainably so. So that means that people are still making money, they're employed, and that means they're consuming. And with a disinflationary trend, that is certainly a bull case. So I think if we're looking tactically over the next 3 months or so, Dominic, or through year end, I would start looking at small caps versus the triple Qs, for example. We've seen a massive divergence there. So I would start looking there. But protect your positions, because Greg is right. There are some big risks here. So you can buy put options, for example. You can hedge the S&P 5% down for this earnings season at a 14.5% implied vol. That's an example of what you can do. You can also add to your positions in defensive sectors, which historically outperform in recessions, because we should not discard recession as a possibility for the coming 12 to 18 months.
All right. Great discussion. Wish we had more time. Kathryn Rooney Vera, thank you very much. Greg Branch, thank you as well. Have a nice weekend, folks.